Star Channel. This is Don Bush. I'm been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. So let's get started. We're working with intermediate accounting today on how to fix accounting errors. And the error for today is purchases. So here we go, folks. So step number one, what did the company do or not do? When did they discover the error? What we're trying to do is figure out what happened. So here's the error. Well, apparently there was an error right at the beginning of 2002, and it wasn't discovered until the end of 2002. And I like to make little simple timelines just like this, so that way you can visually see what's going on. Now here's the error. At the beginning of 2002, a $9,000 purchase of inventory was made. And the inventory was delivered in 2002. So this is a 2002 purchase. However, the accounting clerk included the purchase as made in 2001 and recorded the purchase as a 2001 journal entry when the books for 2001 were still open. So apparently, here at the beginning of 2002, the books for 2001 were still open, and an accounting clerk thought, oh, this was a 2001 purchase, but that was not so. So coming down here to the next step here, the result. So what does this mean? So they made a mistake. What's the result here? What are the implications? So purchases and cost of goods sold for 2001 are overstated. Profit understated for 2001. So, and this all comes down to the cost of goods sold formula. Beginning inventory plus purchases minus ending inventory is cost of goods sold. So if purchases is overstated, cost of goods sold is overstated. And as you probably know, cost of goods sold is an expense on the income statement. So purchases and cost of goods sold 2001 overstated, profit understated. However, purchases and cost of goods sold for 2002 are understated, and therefore profit is overstated for 2002. And it follows the same cost of goods sold formula. The 2001 purchases account was closed to retained earnings during the closing process. So the 2001 purchases account is no longer with us. It's gone. It was closed out. So we won't be able to change that account. And the error was discovered on December 31st, 2002. So here we go. Now, step number two, were there any incorrect entries done or not done? And when were they done? What were the incorrect entries? So on December 31st, 2001, the bookkeeper debited purchases and credited accounts payable. So here we go. So this purchase was backdated into 2001 for some reason. And in 2002, an entry to record the 2000 purchase was not made. So there wasn't any mistake made in 2002. It's just 2001 is where the problem is. Now, step number three, what should have been done? Now, the reason why I do step number three is because I want to know what I'm aiming for. What am I trying to achieve here? What should the books really look like? And so here is what should have been done if the bookkeeper would have made proper entries. So on December 31st, 2001, no entry should have been made at all. It was not a 2001 purchase. And in 2002, they should have debited purchases and credited accounts payable for $9,000. So the bookkeeper actually did the right entry. It was just in the wrong year. So we've got to fix things. Step number four, are the books open or closed? This is a very important determination here. So for 2001, the books are now closed. We cannot make journal entries dated 2001. We cannot change journal entries dated 2001. The income statement has been closed to retained earnings. So that account purchases and cost of goods sold all has been closed to retained earnings. 2002, the books are still open for 2002. This is a good thing. So we can still do journal entries and we can make changes and corrections. So all the accounts can be changed. And in 2002, errors can be reversed. I like doing that if possible. It just makes correcting things so much easier. And also in 2002, we want to avoid creating new errors. It is so easy when you're correcting errors to make things worse. And I have done that. And fortunately, though, it's easy to fix. If you discover that the correcting entry that you've done is incorrect, just reverse it out and start over again. Try something different. So step number 5. Now, if incorrect entry made in current year and books open, reverse out the current entry made in the current year. So in 2002, there was not any incorrect entries made. They forgot to make an entry. They put the entry in the wrong year, but in 2002, there was no incorrect entry made. And so there's nothing to reverse out. And that's too bad, because that makes it easier to fix. Step number 6. Well, let's fix things. Let's make the correcting entry. So step number 6, in 2002, here at the very end of 2002 when the error is corrected, we need to debit purchases because the purchases happened in 2002. And the question becomes, what are we going to credit? We can't credit accounts payable because if we do, we may accidentally pay the accounts payable a second time. So accounts payable is off the table. And we can't credit purchases for 2001 because all that's been closed out. So our only choice, our very best friend when we're doing correcting entries, is retained earnings. And this is appropriate because the profit for 2001 was understated. So let's bring up that retained earnings to the proper amount. So there's a couple of reasons why this works. So debit purchases, credit retained earnings, and that will fix it. I've got an optional 7th step, but it's not useful this time because the entry in step number 6 is as simple as it gets, and it'll also match what your textbook says too. So there you go, folks. I hope you enjoyed this lesson. Hope it helped you out. And if it did, hit that like button and subscribe. And I'll keep making these videos for